And we are live.
All right.
All right, guys. Welcome back to the channel. This is Jason, host of Fighting Words Financial. And today I have my good buddy Amar on the line here. And we have a disclosure up. We are both licensed advisors here. And we do need to put up some disclosures here about opinions being expressed in this program are for general information purposes only, not intended to provide specific advice or recommendations for any individual or specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, contact your consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital, LLC, is a registered investment advisor. Advisory services are only offered to clients and prospective clients where Client First Capital and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital, LLC, unless a client service agreement is in place. And yes, I finally have one of my subscribers from the UK saying, finally made it to a live stream. And he's probably seen you in a couple of other videos that we've done together. So just full disclosure here, I do have a working relationship with Amar. He and I have worked together off and on for a decade. I do consult for his company now. So he and I have worked together for a really long time. Like I said, I respect his opinion a lot, and we don't always agree, but I respect his opinion a lot. And we want to talk about a couple of pitfalls, especially when I talk to people right now about their investments, because of the nature of my channel and what I talk about. I talk to a lot of people that don't necessarily have the two things in place that are guaranteed for you to fail in your investment journey if you don't have these things in place. And that is a process and a philosophy. Okay. Mostly you need a process for determining which investments are right for you. You need a process for determining how much risk you're willing to take. When you're suffering losses that make you want to pull the plug, when you need to hold tight, and you need a philosophy that kind of guides that as well. So we're going to talk about a few things. And this is Muhammad, also from Saudi Arabia, here is saying hello. And I just contacted him via the YouTube comments, and he was just complaining that because of the time difference, he never gets to make it onto a live stream. So a few things about this live stream today, guys. We will not be giving advice on individual securities. We're going to be talking about the process and philosophy that guides investments. We're going to be talking a little bit about what you may want to expect for the market going forward. I know things have been good for a little while. We've kind of recovered somewhat from the rocky period that we had for the last 120 days or so. But I don't think that volatility is over, and I think Amar agrees with me, and we'll talk about that a little bit later. So Amar, talk to me about what you're seeing going on right now, especially with some younger investors who are maybe in their 30s and 40s.
Yeah. So what's going on, buddy? So I think we should keep this casual somewhat. So if you have questions or comments, maybe we'll pause every now and then and take some of those, Jason. So my name's Amar Shah. I'm a CFA, CFP. I'm founder of Client First Capital. And kind of going to what Jason said, in our previous life, I guess in USA days, we saw a lot of things that younger people didn't really have in place. And that was a process.
Yeah. It's too early for beer.
Well, it's 5 o'clock somewhere.
Yeah, that's right.
It's a process or a philosophy, kind of like a thought process of when to get in, when to get out, taking into account, different factors. So want to create kind of a framework around that, kind of talk about how we manage money, how we risk manage money, and we'll go into some of those things today. So the first thing I think we should start with is, having a framework in the process. So one of the things that we look at, and I think it's really important when you're building a strategy, is to figure out what your risk appetite is, right? If you don't know how much risk you can take on, it's hard to kind of manage money on an ongoing basis. So one of the things, Jason, I think we talk about is downside risk, right?
Right.
And that
So how do we
downside risk.
quantify risk though? How do you come to a figure that the client says, hey, this is where this is the limit of my patience?
Yeah, and exactly. What is your limit of your patience? Like, how much on the downside can you afford? Because if you think of investments, there is some like probability analysis around you can build a portfolio that would have a worst case scenario of X. From probability standpoint, that worst case scenario needs to be either 2.5 to 3 standard deviations on the downside, right?
Right.
So meaning that there's a 97.5% probability that you get to that downside. Well, whatever that portfolio that you built is the right portfolio for you, right?
Right. So when we talk about standard deviation, let's say like you have a portfolio that's like a moderate portfolio, which no one uses a moderate portfolio anymore.
Yeah.
But it's a 50-50 or a 60-40 portfolio where your range of returns should be within one standard deviation, meaning that 68% of your returns are probably going to be somewhere between 15% on the upside and about 8% on the downside.
Right.
And then somewhere less than 94% of your returns are going to be within 2 standard deviations, which is somewhere between like -30 and -6, or I'm sorry, +30 and -16.
Right.
So,
exactly.
and there's a 6% chance that you get some returns outside of that, which means you're going to be below that -16%, somewhere in the 20 or 30% range.
Yeah.
At what point are you like, dude, I can't take this anymore? That's how we define downside risk.
That's how we define the appetite for risk. But then there's also a need for risk, right? Like, most of the stuff that we're working on is long-term investments, long-term planning, getting to the point of financial independence or ability to start a business or second career. And so there's also a need component based off of your financial position. And so factoring those two together, you get kind of like a field goal post, right? And then you got to figure out where do you feel comfortable within that range to actually take on risk. The other part I would kind of mention, which is not really investment related, but the need to have a cash reserve or emergency fund, because once you get to that lower end of your risk threshold or actually getting exposure to that risk threshold, it is very important that you can sleep at night and knowing that you have some money in cash and that you have the time to wait out the market cycles. So I think that's something important to build in.
I think it's an extremely important point. So in terms of dollar amounts, or when you talk about time, how much time do you need to wait out a market cycle? How much should you have in an emergency fund?
This is a really good question. I think it depends on the individual more than anything else. Let me give you an example. If you have an extremely high risk portfolio, you're going to want to be more conservative with your emergency fund because the amount of volatility that you're subjected to is higher, and that need for that safety net is now more. Right. Whereas if you're a conservative investor and you have very low risk investments, which, hopefully if you're young, you don't have low risk investments. But if you are, then you can be more aggressive with your emergency fund, and it can be smaller, and that time period it can cover could be coming, closer to the traditional rule of thumb, which is 3 to 6 months, right? So, I believe that's really dependent upon the inverse of the amount of risk you want to take.
Right. So I tend, because I'm a high risk investor, I also tend to have a fairly substantial emergency fund. And I talk to people all the time that say, well, that's a conflict of investment values. Like, it isn't really. I can take a 60% loss and sit on it for a year. And no, I don't like it, but I don't have to disrupt any of my super long-term plans because of temporary discomfort with where my account is going.
Yeah, let's bring this to reality, Jason. Like, we were advisors in 2008, 2009. And a lot of people that sold out had a need for those funds. They didn't want to sell out, right?
Yeah.
Like, I should say a portion of the people. A lot of the people were fear, and they thought the earth was ending, world's ending type stuff. But there were a certain population that didn't have enough emergency funds that they needed access to that liquidity, especially if you're dealing with individuals in retirement. Right?
I learned a lot during that financial crisis, and we're not staring something like that in the face right now. But one of the things I learned about the financial crisis is that most of the fears that investors have, most of it is actually fairly unfounded. And for this reason, like some of the most fearful people that I spoke to, the scenario that they described really was an end of the world type scenario. Like it was like total collapse of the economy type scenario. And I'm like, well, then your money's going to be worthless too. Right. So that was the whole point. I'm like, so if you're pulling your money out of the stock market because you think the entire economy is going to collapse, well, your cash is going to be worthless as well in that case.
I oftentimes find the most dangerous thing you can do for investments is have accessibility on a phone, right?
Yes.
And with this pandemic, a lot of people have been stuck at home, working from home, so they have the TV on, like CNBC, whatever, Bloomberg, whatever your flavor is for financial news, and you have accessibility to your investment accounts with the finger touch away. That is bad for your long-term investments. But
it's bad for your long-term investments. I tell people all the time that lately I've been accessing my accounts more often, but it's probably not more than once a week or twice a week.
Yeah.
That's just the nature of how I invest. I don't worry about the immediate term. I like to watch it just like everyone else does. I'm a human being. But my theoretical holding period for everything that I own personally is theoretically forever. I don't like taxable transactions. I don't like, I don't like regret.
Let's go into this. So like a framework would be like really identifying what your needs are for the funds, right? And then creating a time horizon, some risk evaluation, how much risk you feel comfortable taking on, and then managing the money by putting it in those investments and having I guess the second part is the risk piece of it, how to manage some of that risk, right. In that framework. So, one of the things that we do, and I'm going to share my screen again. Sorry, Jason.
Go right ahead. Hold on a second.
Does this come up?
There we go.
So we have a framework with GDP and CPI, and using the rate of change between these two, we can look at asset classes to overweight to underweight based off of the environment. So risk happens slowly and then all at once. And so when you're tracking this, what you're tracking is the rate of change. And the rate of change is important because the rate of change gives you directionality, right? And so if you think of like a sine curve, going up and down, right? When the rate of change is accelerating, then you're going towards the top. When the rate of change is flattening, then you're either at a peak or a trough, right? And if the rate of change is going negative, then you're decelerating, right? So when we kind of talk about the environment that we're in today, I think that having a framework to manage risk is really important, right? This is our framework. This is what we use with our clients. But, there are other factors that you can use, like price, right? You can use price as a framework. I know people that use stop losses and stuff like that to kind of manage downside risk. Volume, like if you see the volume increasing as the price is going down, there's probably more downside risk, right? The more people are starting to sell. Conversely, if the volume's decreasing and the price is going down, then there's less people selling. So maybe it's a bottom in that security, right?
So recently there've actually been quite a few rebalances with a lot of firms, tactical rebalances for the future. Like what are we looking at that triggers a rebalance in a professionally managed portfolio?
Yeah, so let's take this as an industry view and then kind of what we do at Client First Capital. And then maybe we should remind people that that we also have a YouTube channel. It's at Client First Capital Learning, and you can find all this other pieces of information there as well. Please subscribe. Right?
Excellent.
So the industry, right? So let's look at this. Like the big, larger firms, probably do a rebalance on a quarterly basis. They
Mm-hmm.
don't put too much investment into when you should rebalance. They just say quarterly, so it keeps you closely tied to your risk tolerance,
Mm-hmm.
right? So there's no drift. And so I think it helps keep, the compliance and the risk aligned. And so they just do it every quarter. Do you need to do it every quarter? Our opinion is no, right? Our opinion is that we have a threshold in the terms of how much has your portfolio shifted. Let's say, and I'm just using round numbers, if that threshold is 10%, your portfolio can move up and down probably throughout the whole year, and you could have no rebalances, right? A year like when COVID happened, we had 5 rebalances, right? I mean, that was a rebalance heavy year because as things shift, the portfolios shift, and we were forced to rebalance. The positive side of that was that we were able to buy more equities on the way down, and on the way up, we were selling some of those equities to take risk off the table. So quarterly is one, based off of asset movement within the portfolio is another. And I think another one that people may tend to look at is large indexes. How much does a large index move? So if there's a change, let's say you deposit money in an investment account on a Monday and the index was at X. When that index goes to plus 5% or minus 5%, that's when you can trigger a rebalance, right? Okay. Regardless of what your actual investment is doing. So I think those are the big 3 ways. We fall in the second bucket where we're looking at your specific accounts and how the correlation between those individual investments that you have, how they act together, and where you're flowing from a portfolio standpoint. So we use risk tolerances in environments where there's, let's say low volatility. Those risk tolerances are larger, right? So we expand our risk tolerances between when we rebalance and when there's periods where the VIX is, less volatility, let's just say, then, we probably make those tighter. Right.
Right. Okay. And right now, as we're looking forward, we're definitely tightening those risk tolerances. We think there's a lot of risk out there in the economy. I tend to be a bit more upbeat than a lot of people are in regards to the economy. What I see is a lot of pent-up demand and a lot of really positive forward-looking indicators. And what you were saying too about deceleration of certain indices that are rising, like inflation for one, like the rate of acceleration has definitely slowed. So it's flattening out. So we're either at a trough or we're kind of close to the top.
And maybe I can make my positioning a little bit more clear here. So when we look at that framework with the plus or minus with growth and inflation, our belief is inflations were at the top end. The CPI print was today, right? Like I think it came in at 7.5.
7.5. Yeah.
Yeah. I mean, I think in February, March, that number is going to start to turn. We're flattening and we're starting the deceleration portion.
It may not feel like it to people, but the rate of acceleration has really slowed over the last 60 days.
And this is how I explain it to people is that, let's say you're in your car and you're at a traffic light and then you push the gas pedal, you're accelerating, right? So your speed is getting faster and faster. What we're seeing is that you're taking your foot off the gas pedal. You're still moving forward, but you're just starting to slow down. The fact that you're moving forward means that things will still get more expensive, just not as fast.
Right.
And I think that's something to take into account.
Yeah, it's not necessarily a comfort to people right now, but it's not like the beginning of the end of inflation, but maybe it's the end of the beginning is what we're looking at. And I think I'm quoting Winston Churchill when I say that. But yeah. So interestingly enough, though, when I'm thinking about personal risk philosophy, let's talk a little bit about the differences that we observe as financial advisors between the joy that someone gets for upside returns and how unequal that is when we look at the despair that people feel on downside returns, meaning that you get a lot less joy out of an 8% positive return than you get despair from an 8% negative return. And why is that? It's a weird psychological trick that our minds play.
Yeah, I think it's just the hurt factor,
The hurt factor. Yeah.
Yeah,
But
meaning you don't want to lose, right?
you don't want to lose, but rationally, it doesn't make a ton of sense. Like you've had 3 years of 12% returns, and then you have an 8% loss, and you abandon that philosophy.
Yeah.
We see that happen a lot. And the reason that happens is because people don't have a process that they stick to. It's completely emotionally based.
Yeah.
If
you're making emotion-based decisions in the moment, if you don't have a framework that you're working off of to say, hey, we need to buy here or we need to sell here based off the framework, you're gonna get hurt.
Yep.
I mean, it's just as simple as that. And you may be right for 2, 3, 4, 5 years, right? But once you get hurt, it's going to hurt bad because the amount of leverage you take in terms of risk, in terms of, I don't know if you're buying on margin or whatever, but as you get more confident in your emotion-based process, the amount of risk you take on tends to be more over time.
Yeah, and that's an important point to make, is that you get immediate validation of an irrational decision that you've made, and it creates a sort of false premise in your mind where
it's like a false 2 positive or whatever they call it, type 2 error or whatever.
And it happens over and over and over, which is one of the reasons why, and not all financial firms are created equal. You must be dealing with a financial firm that makes evidence-based decisions.
Yeah.
There are plenty of firms out there, like especially smaller RIAs, that do not. You want to be with a data-driven advisor if you choose to have an advisor.
Yeah. So let me kind of walk through this. So like we're looking at inflation, we're starting to see that decrease in terms of rate of change. Growth is also kind of stabilizing. I mean, it's less good, is decelerating than compared to inflation. But like if you look at the rate of change, if inflation was like this, like it's in terms of steepness, I'm trying to kind of show an angle going down. Growth is like this. It's less steep. The angle is less steep. The slope is less. And so within that, you look at manufacturing, people have, pay rates have gone up. So good wages leads to good consumer spending, which leads to, this inventory backlog staying, even though it's getting better, it's still there, right? If you buy something today, it's still going to be delayed. It's just not going to be delayed as long as if you bought it, during the peak of COVID. So as long as wage growth remains high, inventory cycles continue to support production. If you just look at those two factors, the growth and inflation, kind of what we showed in the model earlier, you're going to think that this is a good market to invest in, right? Mm-hmm. You look at CTFC futures and you see everybody's, SPY, all the market sentiment is positive on a lot of these big things. But I would argue that in the economy, in the U.S. economy, because this is global, right, Jason? Mm-hmm. I'm assuming.
Oh, yeah. We have people here from Malaysia, from the UK, from everywhere right now.
When you look at the global economy and when you look at the U.S. more specifically, in the U.S., we have two levers on the economy. We have monetary policy and we have fiscal policy. Okay. Monetary policy is what the Fed does in terms of fighting inflation. They raise rates, lower rates. They can do quantitative easing, and they do quantitative tightening, which they haven't done any of that lately. So quantitative easing is the bond buying programs and whatnot. The part that makes us nervous, and this again is only for educational purposes, but if you have the Fed looking to raise rates, right? They've said in March of 2022 they're going to start to look to raise rates.
Yeah, the next meeting is March 16th to 18th. So
yeah, so and you have the fiscal policy where our fiscal spending has shrunk from a perspective of we don't have any pandemic spending, we don't have any stimulus, we don't have any PPP loans, we don't have any airline bailouts or hotel leisure packages to where they can help support their staff in terms of unemployment benefits or child tax credits or anything like that. that's going to be roughly about like in our analysis, $1.3 trillion less of spending that happens in calendar year 2022 relative to 2021.
Right.
So you take out that spending, you have raising interest rates. That's not good for the markets. That is definitely not good for the markets. And so I wouldn't say it's a possibility. I think like from our framework, we're on this side of the fence that we think it's a probability. And then if we think it's a probability, then, we're trying to measure how much downside risk with our current holdings will our clients be comfortable with, right? And so one of the things that
so it's just wanted to interject here. We're actually Frantic Pillow. We're actually kind of answering this question right now. It's all probability based. I think I think if you want to look at the probability of bullishness and bearishness, they're substantially equal at this point. I don't think you could really fall on one side of the fence or the other if you're looking at the evidence, because the indications are actually conflicting right now.
No, so I'll disagree with you, right? Like, because we're taking a position, right?
Okay.
Right. We're saying if you look at growth and inflation only, you're going to have a bullish sentiment on the markets. What Frantic Pillow, I think, was that?
Frantic Pillow. Yes, longtime subscriber.
What we're saying is that if you just look at those two, you'll be bullish. However, if you look at what's happening from monetary and fiscal policy, that will supersede what we look in terms of inflation and growth. And because of that, we are becoming more conservative in our positioning. Let me give just 3 examples. Let's say if you have a 60-40 portfolio, 60%, and you haven't done any rebalancing, 60% over last year has floated up to about 68 to 70%, depending on your timing. Right. We're selling that, bringing our equities down closer to 55%, and we're rebalancing those extra funds into government bonds.
Okay, so explain the sort of asset creep there, because some folks here might not understand that. So you had a portfolio that was 60% stocks, 40% bonds last year.
January 2021.
Right.
And then now is, let's just say, we'll use the peak of the NASDAQ, so November 2021. That portfolio now is 70% equities and 30% bonds.
And that's because the stocks inside of the portfolio grew faster than the bonds did.
And then that's what's caused that. And so when we look at this from our perspective, by rebalancing and reducing the amount of equities, even underweighting from a 60-40 portfolio to 55, we're taking a lot of that profit that we got and we're rediversifying that profit into low risk investments, right? So if you think about high risk, you think about energy, small caps, technology. When you think of conservative investments within equities, you're thinking utilities, dividend paying stocks, consumer staples, all the boring stuff, if you will. Right.
And that's exactly the way I describe it on my channel, is the boring stuff.
Yeah. So that's the second piece of what we're doing. And then the third piece is that we're carving out a position in US dollar, Again, going back to the cash reserve emergency fund question or thought process that we were talking about earlier, is that you want to make sure that there is some dry powder if something goes wrong, if the markets crash, that you can take some of that and sell and buy into some of these higher, potentially assets have dropped significantly to the point where you can buy low and ride the wave back up when you're rebalancing. So,
I think the point should be made too, that inflation is not a U.S. concern. It is a worldwide concern.
It's a global concern. Yeah.
It's a global concern right now. Turkey's has massive inflation. The European Central Bank is raising interest rates because they're starting to see inflation. We're looking at Japan is pretty much the only country right now that is not seeing inflation. Everywhere else is at this point.
Yeah. And so, I mean, when you look at what we're doing, is we're essentially taking risk off the table, right? And we can be wrong, right? Nobody has a crystal ball, right? We're basing this off of probabilities, right? Yeah. And the probabilities in our model is saying that, hey, Fed's probably going to raise interest rates I think we're in a mid-cycle election year. Nobody wants to have high inflation when they're trying to get reelected.
But no one wants to have a stock market crash either. So, yeah.
So I mean, it's a difficult. Stock market crash typically hurts the big guys more than it does your average voter, right?
Right.
So I don't want to get into politics, but when we look at the markets, right, we look at the markets in several different factors. We look at it: U.S. markets, non-U.S. markets, the fixed income markets, the currency markets, and the commodities markets, right? And if you were just to take all those markets and see what they are signaling, for example, you look at high yield junk bonds versus their treasury spread, or you look at the 2s and 10 rates, both of those are also indicating, like not panic, but like caution, red lights, or I guess caution's yellow lights on a traffic light.
Yeah.
I guess red lights is stop. So
okay. So
in that analogy, I would say red lights.
Maybe we should keep you off the road, Amar.
Yeah.
So that's something. At least up until yesterday, the yield curve had been steadily flattening, which was concerning. And then we had kind of a big pullback on yields yesterday. But I think the biggest sign for me that it's too late and something really bad is going to happen is the inversion of the yield curve, which we have not seen yet. And I think I can only remember on one occasion where, at least in my career, where the yield curve was inverted and we didn't have a recession. And that was in 2018. But we're not there yet. So that, to me, that's the biggest signal that, hey, man, it's too late to do anything. We're going into recession. So hopefully that's not going to happen. But that's something for you to keep an eye on, is the Treasury yield curve. And as that flattens, you may become more concerned about the future of markets.
Yeah, and I talk to young people all the time, and it's like, I'm young, I got time, I don't want to sell and pay taxes, and but the reality that from our view, right, is that paying taxes is better than taking significant losses, right? I mean, at the end of the day, it's total dollars that you have, your wealth, right? And if your wealth is going down because you didn't want to pay taxes, there's a higher probability that eventually, when you do sell, when gains are little, then you don't have the tax issue, but then you won't have the wealth either. So, and so I think to kind of put a bow on this part of the conversation, it's just to say that policy risk is high, right? Mm-hmm. The Fed is trying to raise interest rates into a growth slowdown with the fiscal spending also reducing, right? And that's our opinion in terms of our firm. But there is, a possibility that we could be wrong, right?
Yep.
But this is something that we're what we believe, right? And so
sure. And I want to make the point, though, you shouldn't look at this as being all negative. It's certainly not. If the Fed is looking to raise interest rates, it means the economy is overheated to a degree.
They're trying, and they'll try to curb inflation and stuff like that through.
We're really close to full employment. There are 11 million jobs that can't be filled right now. Income is rising for folks in the lower income strata. Things are actually looking really good in terms of future consumer spending. The problem, of course, is that we're seeing inflation at this point. So it's not entirely a terrible sign. The idea, though, is that the Fed wants a soft landing when it comes to the economy. They want to slow the economy down, not crash it. And they've had a couple of spectacular failures in doing that in the past. And
if I was a betting man on the Fed, historically speaking, they haven't done this correctly.
Yeah. They tend to have gotten crises better on the downside, a lot better in the last couple of years handling those, but they're not very good at slowing the economy down softly.
Yeah.
Yeah. So, all right, let's move on to that next piece there in terms of philosophy, or what was it that you wanted to talk about today, Amar?
Well, no, I think just let's finish up the risk management. So, there's position sizing, right?
Yep.
You shouldn't have a position that's an equity position that's more than 10% of your overall portfolio, right? I mean, that is taking on more risk.
Yes.
And this number is different for everybody, right? if you work at a tech company and you have a concentrated position in your company, I mean, you're taking on more risk than you think, because if you look at it, your current income is coming from that company, your future income, your savings, or your past income, which you put in savings, is coming from that company, and your future income, right? So that is, you got to diversify. You got to look at your position sizing. You got to look at price. You got to look at volume. We talked a little bit about decelerating volume and increasing volume earlier. And then the other part, I think the key to this is volatility, right? Volatility is a big piece of this, and you got to see in your portfolio, if you have one stock that has extremely high volatility and you have another stock that has less volatility, or let's say ETFs, right? So I have two baskets of securities. One has way more volatility than the other. Well, you can put more money in the lower volatility piece than you can in the higher volatility. You got to adjust your positioning for that. And I think that's important. And this, again, is specific to younger people from things that I've seen over my career where people have gotten hurt. Again, sizing is a big piece of risk management.
Right. And when it comes to investing, you and I have both noticed this phenomenon. It's well documented that investors often have a much worse experience than the investing vehicle that they put their money into, meaning that a mutual fund or portfolio or an ETF might do 12% over time, but that investor is making 3 or 4%.
Yeah.
And most of that is driven by individual decisions, not having a process, not having a philosophy, and not having patience is some of the things that I'm seeing.
Yeah.
Yeah. Would you like to elaborate on that? Yeah, go ahead.
No, I think look, we're hitting on the two big things over and over from different angles. So hopefully individuals that are listening to this can read in between the lines or figure out what we're saying. Is that process and risk management are key when you're going into a volatile environment, right?
Yeah.
So figure out a process so you're not deciding on the day when things are down 10, 15%, like, hey, should I sell or should I stay in this, right? You need to have that framework ahead of time. And then you have to have a risk management process so your overall portfolio doesn't tank, right? Like you right-size positions, you right-size the volatility. And we think this next 2 quarters will be an opportunity to test yourself if you actually have those two things, right? So second and third quarter of 2022 will be more volatile as we go into a raising interest rate cycle. So
and let's talk about that test. I don't think there's a lot of new investors out there. I think it's been close to 11 million accounts added since 2019 by Robinhood. Almost all of those are folks who are new investors, right?
Yeah, dangerous.
But here's the thing. Since 2018, 2019, it's been very hard to lose money. Like, it's been extremely hard to lose money. And everyone's a genius in a bull market. And I see the people that talk to me via this channel, I see that their portfolios actually lack diversification. They own a bunch of stocks, all in technology. Nothing wrong with that if you understand that you're an all-risk portfolio. If you are looking to grow your overall wealth and have any degree of stability whatsoever in your portfolio, you may not realize how under-diversified you are. And that is, you may have realized that since November, because if you're a technology investor, you've gotten crushed. Far more than the S&P 500. I think the S&P 500 is probably down 4% since that time period. You're still down close to 10% in a tech portfolio, or even more, right? When we talk about diversification, what is true diversification, Amar, in a portfolio, and how does that protect you?
Yeah, and let's end with this one, Jason, and then we can wrap it up. So, true diversification. I think it goes back to risk management and everything we've talked about, right? It's like, owning things owning investments that you can rebalance in and out of as the environments change, right? So diversification really deals with correlation, right? So if you have, like, let's say Russell 1000 and the NASDAQ, that's like very highly correlated. That's not much diversification, right?
Right.
But if you had the NASDAQ and US Treasuries, you probably have some diversification there, right? So trying to find a way to look at the correlation between the investments that you own and to say that they're, statistically and different, right, is the key there.
And that means owning things across different security types, across different industries,
sectors,
size, sectors, all that stuff.
Yeah. So like, and that is one of the things that, I think we often see is that people own the same stuff just in different types of accounts.
Right.
And that can be dangerous as well. So it was good speaking here. Jason, I don't know if you want to end it on some notes, but
yeah, I just want to say everyone should probably take this opportunity to re-examine their portfolios or to consult a professional like Amar or myself. Even you can contact me through the channel. My email address is always at the end of the videos, or you can contact Amar at clientfirstcap.com. Just go there and you can fill out the client contact sheet. It's clientfirstcap.com.
And we have a newsletter that goes out monthly on there.
You can sign up for that.
And then our YouTube channel.
Absolutely. Oh yeah, that's Client First Capital Learning, and I'll post a link to him on the community thing. But I just wanted to say thank you guys for tuning in. I realize this is not a regular time that I do live streams, but I do have audience that's worldwide at this point. And Pat Mulligan from Ireland says, thanks for the education. And I do have an audience that's worldwide at this point. I'd like to address concerns from everyone. I want to have more people on at this time too and start building an audience. So Amar, I realize not that many people showed up this time. It's not my regular time. But anyway, thank you very much for coming on today, Amar. We're going to end the broadcast right now, and I'll see you guys next time.
Thank you.